Well, for more on the markets, I want to bring in Brian Belski. He's the chief investment strategist at Oppenheimer. Joined us last month, of course, John and Dom with us in this conversation. Brian, you know, a lot has happened since last month that you talked to us. Has anything changed structurally in the markets for you?
No, it really hasn't. We've seen a lot of change in terms of prices here and there and everywhere, but you know, we actually think we're in a transition period somewhere between a secular bear and a secular bull. People ask me, you know, what do we need to get out of a secular bear? And I think that's already happened, right? We need prices to go up, and they have gone up for the last 2 years.
Right.
So now what we need is for structural leadership to take place. From a sector standpoint, we're starting to see some changes, right? We're starting to see some changes in terms of quality leadership, right? But what we really need to see,
like who?
Well, industrials, for instance. Industrials, one of the best performing sectors year to date. We saw a huge move in energy in the first quarter. We think that likely was more of a momentum type trade. And then lately we've seen some strength in healthcare. But what's interesting about healthcare is it's a very limited list of stocks that are actually outperforming. It's 4 or 5. And if you rank the largest stocks in healthcare in terms of market cap, it's all the big market cap stocks because investors, meaning portfolio managers, are just indexing healthcare. So I think really the new leadership of the next great bull market, which we think we're in the precipice of, will be industrials and technology, principally because they're high quality assets, great balance sheets, great cash flow, and more importantly, very consistent earnings growth.
But technology has been sort of a middling performer so far this year.
It has. It's had fits and starts, much like the market, but technology, there's such a differing type of sector composition right now. You have the big cash uglies, right? The big old leadership, and then you have some of the exciting new stocks with concepts, which had a great year last year. We think actually the quote-unquote big ugly cash guys are going to be the stock leaderships of the next bull market.
And to Brian's credit, since he was last here, the tech stocks are up about 4%. They've held a lot of that value. The group he said don't buy last time were the commodity-related stocks, the materials.
Right.
They went up another 4%, but then they came down 4%. Now, because they've come down, they're basically where they were last time you were on. But have you changed your view? Do you think if there's more selling, you'd say, well, you know, maybe I will change my tune on those stocks?
You know, we don't buy stocks because they're down. Number one, we buy stocks because we think there's some fundamental merit to it. And typically and historically, momentum ends very badly. We have a parabolic move and then a parabolic move to the downside, i.e. what's happened to silver, right? And so materials have been one of the worst performing sectors year to date because of the volatility. Now, within the material space, we tend to like the base metals like steel and aluminum because there's actually some pricing mechanism there and there's some decent earnings growth. But in terms of pricing for the precious metals, they're at or near all-time highs. So how much better can the pricing get? So therefore, how much better can the earnings get?
Well, the commodity story has been centered so much about what's happening globally, specifically in places like China. We are seeing mixed pictures coming out of Europe right now. We see some industrial production numbers doing well, others saying that they're not as good out there. Is there a real view right now from a macro big picture point of view that world growth is there to sustain a stock market move, or are there just too many headwinds right now?
I would say there's not a real view. I think at this point of the cycle, Dominic, it's very interesting. It's a very interesting time to be actually going out and talking to clients, right? So what we find relatively disturbing is that clients want to chase the prior leadership still. Over the last 10 years, what's outperformed? Small cap, high beta, emerging markets, material stocks, anything to do with commodity or weak dollar. They're still chasing that. And we know from studies that the prior leadership's never the new leadership. Yet we see clients still wanting to be in these names. And so coupled with, that most of our clients, meaning a lot of the mutual fund investors, have actually underperformed. So when they see these rapid moves to the upside, they want to react and try to play those. So we get nervous when we hear that kind of things, and only reinforces our viewpoint in terms of a process of being an investor and look for quality assets.
Brian, quickly, why hasn't, though, the macro data caught up with what we've seen in the moves in earnings and in stocks?
Well, I think what's interesting is that I've been on the show before saying stocks lead earnings, which lead the economy. The economy was actually stronger 2 quarters ago, right? So if you believe that equation, the stock market probably has to go down from here. And I think why stocks aren't reacting right now is because the first 2 months of the year, Betty, we had inflows into equity funds, so portfolio managers had to put money to work. But what's interesting and what we wrote about this week is we're starting to see inflows back into bond funds because retail investors are starting to get nervous again. And so that's going to really weigh heavy on portfolio managers that have been underperforming. And I think that's why we've seen these fits and starts type markets.
And Brian, you were pointing out, though, that what's been interesting about this whole, the whole subsector here of health and the gains we've seen is that it's been led by the giants of the healthcare industry, right?
Right. It's really an effect, I think, that portfolio managers have been so underexposed healthcare because it's dramatically underperformed the last several years. So coming into a dramatic move in stock market in certain sectors in the first quarter, they looked at their portfolio and said, hey, we're underexposed some of these big healthcare names. Let's index them and build our positions again. So literally, if you go to the healthcare side of things and rank the stocks by market cap, you'll see the top 5 performing stocks, not so coincidentally, are some of the best performers. So what that tells me is that portfolio managers are just short-term renting them, and if and when the market really gets going again, they'll come back out of them.
Then what kind of a market is that indicating overall?
Well, I think people, based on our conversation with clients, I think people are becoming much more defensive. So there's 4 defensive sectors traditionally you can go to: healthcare, staples, telecom, utilities. Telecom, utilities, we think, have some structural problems with them. Staples has some higher input cost issues. Healthcare, all the things that were mentioned, exactly right. However, the big question facing healthcare is, where's the growth? Because we've been saying about dividend growth, cash, valuation, all these things for the last 12 years, but where's the growth?
Right, and they've got the patent issues. All of the drug companies do. Brian, thank you so much for joining us.